I hope everybody had a good time last night. I did. I met some clients, and I was asked to go to a restaurant dinner, had nice Italian food, and then they wanted to go to the racetrack. And I know nothing about races, so I watched patiently. And then it was like God spoke to me. In the seventh race, in the seventh post position, was a horse called Lucky 7, going off at 7-to-1 odds. So I bet $777 on it. Came in seventh place. I like that story really because it tells us how our brains work. We're looking for connections. I know many of you are not really so focused on macroeconomics. I probably agree with many of you. You can take all the economists in the world and lay them end to end, and you still don't have enough to reach a conclusion. What I'd like to do is just in a few minutes, really, just describe for you what my conclusions are. I want to give you 4 things to hang it on, 4 anniversaries that are taking place this year. The first one really is 2 anniversaries. These are the bookends of the Cold War. End of World War II, 1945. Germany gets reunified, 1990. I was one of the guys who thought that I liked Germany so much, thank God there were 2 of them. You know what I mean? A lot of the problems that Europe have now is a function of the unification of Germany. And I had this quote from Kissinger there, how Germany is too big for Europe, and that's the problem that our parents had and our grandparents had. Germany is too big for Europe, but too small for the world. So Germany finally has what it's wanted for generations. It dominates Western Europe and Central Europe. Though in some ways it's like a dog chasing a car. When it finally catches it, it doesn't know what to do with it. And likewise, Germany has a model in which it's fostering austerity on the rest of Europe. And what we saw happen yesterday, I suspect, is just the tip of the iceberg. The problem with German austerity is it has a political backlash. Syriza in Greece looks like they're going to put together a government, small majority. So what, who cares about Greece, right? Too small. Most real investors don't have money in Greece because it's below investment grade. But this is a canary in a coal mine. Later this year, besides we have many local elections, at the end of this year we have an election in Spain. And the Spanish equivalent of the Syriza party is running ahead in the polls. I am one of the people who did not think that Greece was going to leave the Union back in 2010, 2011, 2012. I still don't think they leave. I think it's mostly political rhetoric. Nor do I think that Greece is blackmailing its creditors. I think it's called negotiations. When we do it, it's negotiations. When the other person does it, it's called blackmail. When you're thinking about monetary union in Europe, I always thought they had monetary union. I thought a single currency was American Express. But the Eurozone itself really is an economic solution to what is a political problem. Under what conditions can Germany be reunited? They had to share the Übermark, the Super Deutschmark, with all of Europe. We call that the euro. They had to share the Bundesbank's anti-inflation credibility, which means low interest rates, with Europe. And that's done by the ECB, headquartered just down the street from the Bundesbank. I suspect that the problems that Europe is having will continue for many years to come. The austerity, despite the QE, the sovereign bond buying program last week, I think that problems in Europe are condemned to a period of protracted, slow growth and low inflation. The ECB's own model says that the bond that they're going to buy is worth, for this year, about 0.4% to inflation. Later this week, we're going to get the flash CPI for January. The consensus is minus 0.5%. Low inflation in Europe, deflation is going to persist. It's going to mean slow growth, low interest rates, low rates of return. The other anniversary that I think is characterizing, shaping the investment community is OPEC. It was founded in 1960. What happened to oil prices? I don't think there was a big change in supply and demand. These things change very slowly. Instead, what I think happened is people had to change perceptions of the Saudi call. People thought that the Saudis would do what they've done for many years and act as a swing producer. they'd make room for U.S. shale producers by cutting back on production themselves. Saudis say they're not going to play that game anymore. And so what's happening is the market's realizing now that not just U.S. oil production is rising, but so is other non-OPEC countries. This is really the problem in some ways. The Saudis and OPEC left the price of oil too high. It was too high. Evidence of it was it gave rise to a lot of competitors. Not just the U.S. shale and horizontal drilling, but think about what they're doing in Canada. They're getting oil. You know what the Saudis do, right? They stick a straw in the sand and they get oil. Canadians have to get it out of rock. In Brazil, they have to go miles underwater to get to that oil. It became profitable or economic to do so only because oil was at $100 plus a barrel, and our friends like at Zero Hedge would tell us that we're at peak oil. We're not. The problem, though, is why did the U.S. have shale output and other countries don't? 3 things. One, say, is American ingenuity. And that really revolves around the horizontal drilling. What about the shale? You know, many of my European friends don't eat GMOs, right? Genetically modified organisms, right? Genetically modified seeds for corn, say, or wheat. That same kind of concern about health and the environment, the U.S. lacks. So last week, someone in Texas reported that there were 9 earthquakes in 24 hours, relating, they think, to the shale production. So the reason the U.S. has to get to shale production, one is just ingenuity, horizontal drilling, scientific technology, and breakthroughs. One of them is less concern about the environment and health issues. But the third one, and that's why I have this as the Mr. Crude meets Mr. Minsky, access to cheap credit. I don't think it's going to be the price of oil that drops that's going to squeeze out the shale producers or the U.S. high-cost producers. It's going to be the drying up of credit. Think about what we did with the housing market. Banks were able to give ninja loans. Remember what ninja loans? No income, jobs, or assets. They gave those ninja loans because they got the collateral. What was the collateral? House prices. Houses. House prices can only go up. Banks were happy to take that as collateral. Same thing with the oil. Banks and other lenders gave money to the oil sector, not based on the ability to repay it, but on the price of the oil in the ground. They knew they could always take that, and that is what's crashing now. If you look at what happened last week, Schlumberger, Halliburton, Baker Hughes reported earnings. They're claiming that there's been a market decline in their business in North America, 15 to 20%, more than any place else. I'll give you another example. The U.S. has lost about 15% of our oil rigs since October, when it peaked. 15%, it's something like 100 rigs. Saudis, 1 rig less. So the squeeze is going to come. Producers, over time, respond to the price signals. The U.S. oil is still going to rise, output's going to rise, but we're already getting the squeeze on research and development. And the shale production is like quickly exhausted. Something like 60% of it gets taken in the first year. So this means it needs the constant looking for new fields. That is where it's going to hit us. Not so much this year, but next year. That's why I talk about Mr. Crude and Mr. Minsky. Minsky, remember, was the economist used for the crisis as when a period of increasing prices naturally leads to instability because people leverage themselves. And a lot of places are leveraged on high oil prices. A lot of my friends in the green movement, whether it's wind or solar, even the railroads, there's many railroad companies that borrowed money to buy new cars to ship the oil. Right? So the whole oil ecosystem, if you will, was predicated, leveraged on high oil prices. The U.S. had the most leverage. We're going to get hit quicker. The third anniversary is more about foreign exchange, and this is the anniversary of the Plaza Agreement, 1985, Plaza Hotel in New York. The dollar was in a bull market. And at the Plaza Hotel, the G7 countries agreed to drive the dollar down. Many people think that that's what we need again. You see some of the people who thought, like myself, that the Federal Reserve will raise interest rates in the middle of this year are getting cold feet about it. They say, what about the dollar's strength? Isn't the dollar's strength going to hurt exports? Is it going to weaken inflation? Is it going to slow down the U.S. economy? I'd say probably not. In the sense that right now I'd say the strong dollar is part of the U.S. economic strength. That's why money's coming here. I would say actually that there's two reasons why the dollar is rallying. One is because of good things in the United States, and the other is because of bad things elsewhere. In that period, April through September of last year, the U.S. economy had its fastest growth in more than a decade. During that period, April through September, Europe stagnated, Japan contracted. I'm not saying that the U.S. can decouple forever. I'm saying for the time being it can. And we'll see this number again later this week. We get GDP in the U.S. for the fourth quarter. We probably grew something around 3%. Important thing about that Q4 GDP number is one of the reasons why people are having cold feet about the Fed raising rates in June is for two economic data points that came out recently. One was a decline in retail sales. Retail sales is a small part of overall consumption in the U.S. We get that fourth quarter GDP number, consumption is likely to have risen by about 4% at an annualized rate, much stronger than the retail sales number would indicate. The other reason people are getting cold feet is that decline in earnings growth that we saw in the non-farm payroll report in the beginning of January. That report is going to also be at least partly blunted by the ECI, that's the Employment Cost Index that's coming out this week. It's going to show the cost of labor slowly rising faster than the rate of inflation. So I think that for the time being, I'd say that the meaning of the strong dollar policy remains intact. Treasury Secretary Liu just repeated that earlier today. And I know some of you might think, what does a strong dollar policy mean when the dollar can fall to, where were we in 2008, $1.60 on the euro, over 2 on the sterling? What does a strong dollar policy mean? I'll tell you what it means, and this is why I'm one of the people who have been arguing against currency wars. Strong dollar policy means the U.S. will not use the dollar as a trade weapon, the way it did when Reagan was the president, or when Clinton was the president, with before Robert Rubin took office. What this means, it's something like, for me, it's like an arms control agreement. We all know we can have beggar thy neighbor currency depreciations. But we know that's dangerous, just like we know that chemical weapons are dangerous, so we've forsworn using them. Same thing with using currencies as an end goal of policy. Now I know countries like the Eurozone, Japan, they're pursuing very aggressive monetary policies, and it's driving the currency down. The goal is to end deflation, to stimulate the economies. The goal is not just depreciating the euro, depreciating a currency. And because of that, I think that it's one thing for the media and journalists to talk about currency wars, but I don't think you're going to see the G7 talk about currency wars. I think they deny that such a thing is existing now. Which means that we should not expect some kind of concerted effort to drive the dollar down, like officials did in 1985 at the Plaza Agreement. So I want to just briefly just give you a sense then of what, when you put all these things into a blender, which it's not quite the algo trading, but you put this all into the mental blender, what do you get? I have the dollar going higher, that we're still in the relatively early stages of it. That's really the note there on the second point up there. It's important to see how the dollar impacts the U.S. economy. It's not good to look at just a bilateral exchange rate in nominal terms that is not adjusted for inflation. It's better to look at it on a real trade-weighted basis, adjusted for inflation. And here's what that looks like. You can see that we have risen a little bit, but as of now the Federal Reserve only updates this at the end of the month. As of the end of December, the broad trade-weighted measure of the dollar adjusted for inflation was 12% off of its record low in 2011. 12%. What I'm suggesting to you when you look at this chart, I think you'll see the same thing I'm seeing. This is still the early days. If this is going to be a big dollar rally, and that's one of the ways the foreign exchange market differs from other asset markets. Trends can last a long time, years. We are still in the relatively early days of a dollar rally. You can see it's barely breaking that big downtrend. So what does this mean? I went to this forecasting school. You're not supposed to give a date and a price at the same time. I won't break that now, but I'll tell you that I suspect the euro is going well below parity to go test its historic low made in early 2000s, around 85.5 cents. if you use that as your base of thinking about things, it means that even though the Swiss have lifted its cap, and of course they didn't tell anybody, but how could they? You saw what happened last week. Even before the ECB made their announcement on Thursday, it was leaked. A good chunk of it was leaked. I know they said 50 billion was the leak, comes in 60 billion. Not really. 50 billion is what is new money. The 10 billion was what they're already doing, of buying asset-backed securities, buying covered bonds. That's 10 billion. So all they really did was announce a 50 billion new program that was leaked the day before. So how could the Swiss tell the ECB what they were going to do? It was going to get leaked. When the UK dropped out of the ERM in the early 90s, they didn't tell anybody. In fact, that very morning, they were intervening, throwing more money to defend sterling. When the US broke the gold standard in 1971, the US didn't tell anybody. It was a unilateral decision. This is the way central banks operate, and this means that level of risk in the foreign exchange market is greater than we often think it is because we think we can trust officials. We act like we can trust officials. And I think we can until we can't. So in my views, the dollar is going up much higher. Some other currencies, sterling. I do think that if you're looking for a currency that can hold up a little bit better than the euro, I'd look at sterling. Partly I'd say that what happened overnight, think about what happened really last week. MPC minutes came out from the Bank of England meeting, and the two hawks that wanted to raise rates immediately capitulated. They said, okay, we're off that. So what happens over the weekend? Bank of England Governor Carney says maybe the market's underestimating the ability of the UK to raise rates. And that was echoed again earlier today by someone else on the MPC. So most people, like myself, had thought the UK could raise rates this year, pushing it back towards the end of this year. Still think that's a reasonable bet. Long before the ECB can raise rates, long before the BOJ can raise rates, the UK is probably the second out of the major countries to be able to raise interest rates. However, that might not be enough to protect sterling against the US dollar. I think we're headed toward the low 140 area. We just recently traded below 150. Dollar yen's a bit trickier for me because the yen has already had a massive depreciation. I suspect that if there's going to be any kind of political pushback against currencies, it might be against the Japanese yen. You see what happened last night? The Japanese reported their trade figures. Exports to the US are up about 25% year over year. Now I know some of you think that the Japanese are real export machines, but I tell you they're really not. Most of those Japanese cars you see driving around our cities, made in the United States. That's how they service US demand, build locally. Get beyond the protectionist walls, take advantage of what has historically been a cheap dollar, build cars in the United States. 25% increase in exports, though. I suspect that at the US Treasury's report in the spring, they have a pushback against the Japanese if they continue to try to depreciate their currency. Someone was asking me before about the Swiss franc. I do think that the Swiss franc can lose ground against the US dollar. It seems to me that anybody who is short the Swiss franc has been washed out. And that tells me oftentimes when people are no longer short, there's an opportunity there as a contrarian trade. But in the big picture, I want to leave with you before we open to Q&A that my analysis would suggest that we're in the early days of a dollar rally. And the way to think about this, I know as you think about many things that you have to monitor, 4 anniversaries sort of capture the current investment climate. The 2 bookends of the Cold War, the end of World War II, the unification of Germany, OPEC's anniversary, and then the Plaza Agreement, 1985. And there I'd say, don't look for another one. So thank you, and maybe we have some time for some Q&A. Question?
Carl Shimada, Cambridge. Where do European liquidity surpluses go in the year ahead and the years to come?
Good question. So it's a question about European liquidity, and here's what it seems like is happening, is that private sector investors have near record short euro positions at the IMM. They're moving into dollars. The same thing that central banks are doing. You know, we get the IMF data, COFR data on central bank reserve holdings. And the latest data is for Q3. They also, many of my colleagues at other banks have been telling their clients, central banks, diversify away from the dollar, diversify away from the dollar. And so they did. So a lot of these central banks have a lot of euros, too many euros. They're moving back into US dollars. This is one of the reasons why I think US bond yields are so low. We hit our 30-year bond is at record lows. Who would imagine that a 10-year bond yield can be below 2% when the growth, if you give me Q4 growth of around 3%, you're looking at about 3.5% to 4% growth for the last 3 quarters. After last Q1, the winter sort of depressed Q1 GDP, we bounced back, but yet yields are below the growth rate. That tends not to be sustainable. So we have to say, who's buying? I think a lot of this money that's coming to the U.S. that's underpinning the dollar, underpinning U.S. treasuries, I think it's from foreign money, especially people leaving the Eurozone. Earlier, people were saying, why is the Euro so resilient? Part of it was that people realized that they're underweight European assets, and they were when Europe talked about easing, they moved into and bought peripheral bonds, they bought Spanish, Italian equities. That game is up. Partly, I think it's up because you look at those yields. Swiss yields, 10-year bond yield, minus 25 basis points. Germany, negative yields going out for 6 years. So I think that money leaving Europe, avoiding those negative interest rates, coming to the U.S.
Do you see the euro-funded carry lifting EM currencies or having an impact elsewhere?
That's a good question. People are talking a lot about their new carry trade. It seems to me that carry trades we don't really have those conditions right now, like low volatility, wide spread between interest rates. On the other hand, it does seem like in the last several weeks, the emerging markets equities have rallied. I think we're at like 3 or 4 week highs here. And it does seem like some of that money can move back in. If you get negative rates in Europe, there probably are some good picks in the emerging markets. I know we like India, for example. We like Mexico over Brazil, where people can still get high yields in emerging markets. On the other hand, I get a little bit nervous about emerging markets as an asset class. It seems to me that they need 4 things for emerging markets to really sustain a rally. 1 is a weak dollar. Secondly, you need stronger world growth. Thirdly, higher rising commodity prices. And fourth, you need a Federal Reserve who's easing policy. And my sense is that those conditions don't exist right now, which means that you have to be very selective about the emerging markets, more of a relative value trade than just go buy that asset class.
Thank you.